Welcome to On the Money with Ryan Wheelis. He is the founder of Allied Wealth. I'm your host, Spike Spangle, and we are very excited to be here on this program today because we are going to continue to talk about what is happening in the markets this year, the market volatility. And I'm sorry, Ryan, when I say market volatility, I mean downward volatility. It hasn't been great.
Nobody complains about upward market volatility.
Nobody does, no.
Right, because upward market volatility means we're winning. We're making money. And, you know, people get concerned and nervous when they start losing money. And what's really crazy about that, Spike, is that their risk tolerance changes, right? We get complacent. When the market just goes up, up, and up, and up, and up, like it has been,
right?
Everybody's happy because we're getting always great returns. It's like, this is awesome. But when the market starts falling, we start realizing very quickly that we are very complacent.
Right. Folks, so we want you to know that today's program, we are dedicated to your retirement planning, Houston. We want to make sure that you get the information that you need. One of the ways that you can do that is by getting your own portfolio x-ray. It is complimentary, and all you have to do is call the phone number you see right here. We're going to be doing that throughout today's program because, as Ryan's about to say, I don't think we're really going to see an end to this volatility anytime soon, do you?
No, Spike, and we can talk about, you know, what's causing it, and the reality is what's causing it is the very high concern of inflation, right? So, and we had this massive stimulus put into the economy as a result of what was going on with COVID. And so now you have all these dollars chasing goods and services. But the supply chain is frozen and locked up in so many cases and ways. And so what happens is there's not enough goods and services to satisfy the appetite for all these dollars that are chasing them, right? So we have rising prices, and the rising prices are getting pretty bad. I mean, folks at home are feeling the pressure at the pump right now. I know I am. I filled up my wife's car the other day, and I was like, oh, my God, this is crazy, you know? And so what's happening is the Federal Reserve Bank is trying to raise rates to calm inflation down. The challenge with that is that's only half the story. Until we get the supply chain issues fixed, I don't think we see inflation go away for quite some time. And Spike, unfortunately, I think the supply chain issues are largely political. And we don't really talk about politics on the show, right. But whether you're Democrat or Republican right now, you got to know we have issues. And so hopefully some things happen on Capitol Hill to resolve these things, and we get moving back in the right direction.
Right.
But it could be quite some time.
Something you and I have discussed before is a worry for a lot of folks out there. It's a phrase that we use in the industry, and it's called the sequence of returns. But I'm wondering if you can explain, what does that really mean to folks out there? There are folks right now who have, maybe yourself, retired within the last year or two, or you're 6, 12 months, maybe a year or two away from wanting to retire, and they're looking at their accounts, and they're 50,000, 100,000, 200,000 or more down. Are they able to retire? What exactly is sequence of returns?
Well, sequence of returns risk is really something we need to discuss. But before we get there, what Spike's really getting at, folks, is about 90% of the folks that call into the show looking for a portfolio x-ray, which is our offer today, they have no idea about the amount of risk they're taking. They didn't know their portfolio could lose 20, 25% this year, and they're getting very concerned about what's going on. They're losing confidence in that. They're losing trust in their advisor, and they're getting really concerned about what to do. And so what we want to do is talk about the impacts of this stuff, and part of that impact is something we call sequence of returns risk. And to really explain sequence of return risk, let's take a walk down memory lane.
Okay.
All right, let's go back to 2000, 2001, 2002, which is one of the very few times in market history that the market was down negative 3 years in a row. So 2000 was negative, 01 negative, and 02 negative. Well, if you're taking a distribution out of your portfolio, let's just call it 5% for easy math purposes, and the market's down 20% one year, and you take out 5%, well, now you're down 25%. Let's say the market's down 12% the next year. We take out 5%, we're down even more. The market's down even more next year, and I think the overall return over that 3-year period was down about 45%. You took out an additional 15% for income, where your portfolio is now down 49%, folks, or 59%. And to get back to even from that kind of loss takes a 100% return. But going back the other way is very difficult because as you go back up, guess what? You're retired. You still have income needs.
And to get that gain back, that 100%, you got to have your foot on the gas.
You certainly do.
Meaning you're going to be invested in those same risky securities that got you there in the first place.
That's exactly right. You've got to press the gas, and you may find yourself in a situation where you're back in the exact same portfolio, taking more risk. So when the 07, 08 thing comes along, And I saw this happen, folks. People were taking the same amount of risk in 07 and 08, trying to get back to even from 2000,
Right.
2001, 2002, that they went right off the cliff again, right? And so, you know, folks, one of the things that we did at Allied Wealth is years ago, we went back in history and we looked at this stuff. If we focus on retirement at Allied Wealth, we help people retire well with the resources they have to work with so they can live the life they want to, the one they've worked for in their golden years. And so we went to work and we designed strategies that help mitigate downside risk in the markets first and seek to get returns second. And that really helps us combat that sequence of returns risk. Because we know this, folks, you don't need great returns in your golden years to make sure you don't outlive your money. But you absolutely must avoid great losses. And that's exactly what our strategies are designed to do at Allied Wealth.
And that is what we're doing here today, is the Portfolio X-Ray Challenge. Do you know, number one, how much risk you're taking? Do you know what you're paying in fees? Do you know what to do? Should you be rebalancing? And this is a big question. But first, folks, call that phone number you see right there on the screen so you can get your own complimentary Portfolio X-Ray, 844-944-7555. We're going to have to go out to break in a moment, but I want to ask this question real quick. Shouldn't we just be moving over to cash right now? Isn't that the question you're getting from folks?
We're getting that a lot. And if you're down this much and you're thinking about moving to cash, I would tell you be careful, because what you could be doing is locking in a loss. All right. And that may be more of a decision you're making from emotion than reality and facts. So be very, very careful with that, because one of the things you've got to really think about, folks, is in your strategy of your portfolio that you're working with, does it have the ability to do that automatically? Are there ways to move your money out of a risky asset class to a more safe asset class automatically without having to call your advisor? And so many of us think we have that. But coming up after the break, we're going to show you something pretty interesting, because what we see oftentimes is people pay an advisor to move things around, but they're down as much as the market.
Your market strategies when we get back right after this break, but you, Houston, can call for your own complimentary Portfolio X-Ray right here. He's going to take a look at your investments, the risk that you're taking, the fees that you're paying inside there. How long have you been invested in those retirement accounts at work? When was the last time you changed the allocations? And should you keep your monies at those retirement accounts at work? More about that and the market strategies when we come back right after this, but call for your own complimentary Portfolio X-Ray, 844-944-7555. More with Ryan Wheelis, the founder of Allied Wealth, right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Thank you so much for coming back to On the Money with Ryan Wheelis. He is the founder of Allied Wealth. I'm your host, Spike Spangle, and we're talking about market strategies for today's retiree. One of the reasons why you want to call and get your own complimentary Portfolio X-Ray by calling the phone number you see down there at the bottom of the screen. You can see that number, folks, or you can use the QR code as well. Open up your phone, go to the photos there, and you can click and you can go right to the landing page there to learn more about the team. But Ryan, isn't part of what you do at Allied Wealth. So the name of the show is On the Money. We talk about all kinds of things here, but with a focus on retirement planning. But specifically, aren't you trying to mitigate that risk of the sequence of returns that you were talking about a few minutes ago?
Yeah, Spike, the whole thing we do at Allied Wealth is we want to help the great people of Houston live the greatest life they can with the resources they have to work with so they can enjoy what they worked a lifetime for. That's the impetus behind what we do. And so part of doing that is saying, okay, how can we help, right? How can we help? So one of the ways we help is we design strategies that are greatly, they're there to greatly reduce the risk of sequence of returns. And part of how we do that, folks, is we begin with the end in mind, and we focus on mitigating downside risk first, and our strategies are designed to produce no more than a 30 to 40% loss in a down market, all right? And we've been able to do that, by the way. Now, to that end, we are also designed to only capitalize on about 70 to 80% of the upside. But here's what's interesting. People don't embrace it when the market's going up like crazy because we get complacent. And why would I want to get only 70 to 80% of the upside when I'm getting it all right now, right? When the market falls the other way and we start experiencing these things, we start going, wait a minute, this may be a good idea to pick up the phone and call Ryan, which is why we do the show, folks. We're here to help. But to that end, if you have a strategy that seeks to minimize losses first and maximize returns second, what we do is we greatly reduce that sequence of returns risk. And that's a major risk in retirement that can be mitigated, by the way, just by picking up the phone and calling 844-944-7555 and clicking the QR code on the screen. We can teach you all about how we do this stuff.
I think one of the easier ways even to explain it is that, look, you can get somewhere by driving 120 miles an hour.
You can.
But is it safe to do that? You stay within the speed. So that's what you're doing, is saying, look, we're going to get there, but we're going to get there safely. We don't always have to be swinging for the fence. We're doing 100 miles an hour. And because you take it a little easier, yeah, we might be leaving some of the gains that you could possibly get, but that also is what protects you when the market does exactly what it's doing right now.
Well, Spike, let's go back to 2020, all right? And so in 2020, the market on March 23rd was down about 33%. That was the low point. Our strategies were down between 5 and 7.5%, depending on whether you're conservative up to aggressive, okay? And so the strategies, most of them finished ahead of the market that year. So not only do we beat the market to the downside, we actually beat it to the upside. Now, that's not guaranteed, folks. We're dealing with things that we can't control, that sort of thing, with risk asset classes, but we're pretty good at doing that. So if I can mitigate that big dip in 2020, I don't need a 30 and 40% return because you never took the loss in the first place. So by seeking to limit those downside losses, we don't need as much return, and we can achieve steady, consistent returns over time, which give you peace of mind in retirement. And in this situation right now, you're not freaking out and concerned because our clients aren't calling into the office going, oh my gosh, what happened? They're connected to their money. They understand how their money's managed, and you can have the same type of money management yourself.
All right, but what about if somebody is still working? What if they're in their, I don't know, I'm 60, I'm 62, I'm 63, I'm looking at being able to retire soon, but I've got those retirement accounts at work.
So I have a real life experience that I'm dealing with right now with a gentleman who is 62, and he had it made in COVID, and then the COVID crash happened. And he decided to delay retirement for 2 more years and kind of get back, and he did. To his credit, he did. But now he's 62. And he just went through about a 23% loss in his 401k. Not to mention his lump sum on his pension has gone down in value too because rates have gone up.
Wow.
So he's getting a double-edged sword here. He's lost money on his pension value. He's lost money on his 401k, all right? So on the 401k, we sat down and talked with him. We are trying to design an asset recovery plan for him and build this plan for him. But one of the things that just really irked him in a bad way is I said, you know, if you would have come to us at 59.5, what you could have done is an in-service withdrawal. We could have moved your money out of this 401k over to an IRA. That's a non-taxable event. He pays 0 tax on that at all. We move that money from that 401k over to that IRA, and we open up the world of investment options that are available out there to you. I've got programs that can greatly mitigate downside losses in the stock market. I've got programs that have 0 loss potential in the stock market too. And this gentleman had no idea he had the ability to do that. And it's such an important story to tell because I feel like the great folks of Houston need to know this kind of thing.
This might seem like a silly question, but one of my first thoughts is, does the employer care whether you move it or not? Somebody might say, oh, my company's done well for me. I don't want to move the money.
Well, that was his thing. He's like, well, look, you know, I'm surprised I didn't know this. But I asked him, I said, well, do you have an advisor at work? He's like, no, we don't have anybody coming around to our desk in a quarter going, hey, it's time to do a review, or maybe we should reallocate things. And he didn't even know this. And now he's in a situation for the second time in 2 years to where he's having to delay retirement, folks. And it doesn't have to be that way. There's a better way.
All right. So explain to me exactly then, what is a portfolio x-ray? Are you just going to look to see the growth and the percentage and how much money people have saved over the last couple of decades? What goes into a portfolio x-ray for you?
It's a great question, Spike. What goes into a portfolio x-ray is really easy to understand, folks, and that's one of the key things about it. It's got to be easy to understand, all right? So we're going to take a deep dive in your portfolio. What I want to do is test it in 2000, 2001, 2002. Let's look at that sequence of returns risk and see if we can eliminate or mitigate that greatly. Let's look at how the portfolio performed in 2007, 2008. In 2018, 2019, and what I call the secret dip there, and then in 2020, and then thus far this year. And the reality is, if you didn't do that before your advisor put you in the portfolio you're in, or before you selected the funds, you made a mistake. But that's okay. We can help you. All right. We can learn from our mistakes and move forward. In addition to that, we're going to take a deep dive into the fees you're paying. We call fees financial termites. All right. And fees can greatly eat your returns. We're going to look at ways to reduce your risk, increase your returns, and we're going to test those strategies against what we can do for you at Ally Wealth, and we will find a way to get you into a good place. And if we can't, guess what? You know more about your portfolio than you did when you walked into the door.
And lastly, but before we do go out to break, I'll ask you, because we know there are some wonderful companies that are here in Houston, that are here in Texas. What about that company stock inside the four? Is it possibly time to pull back on that, or to rebalance, or to be really careful with this?
I think that the time for company stock right now is to own it. Exxon went to it as a great company in Houston. We service a lot of their great employees there, and it went to an all-time high. It's since pulled back. The dividend's strong. It's doing well, and also Chevron's doing quite well as well. So I think that those sectors have actually helped buoy other parts of 401ks that are down, because energy is the leading sector right now. It's done very, very well. So I wouldn't tell you to lighten up on company stock.
Okay.
I actually think the events of what's going on in Ukraine, which are yet to be over, by the way, are going to further impact the oil market, and you could see even more appreciation there in your company stock. But one thing to think about, folks, is make sure you're looking at Roth conversions, okay? If you can do that inside of your 401k, some plans allow you to do that, some don't. But also look at something called a net unrealized appreciation transaction, to where you can move that money out of that 401k, out of that IRA. There's some tax ramifications to that, but there's a lot we can do for you. And if you're thinking about retiring from one of those great companies right now, and a lot of people are, give us a call, 844-944-7555. Again, 844-944-7555. Click the QR code on the screen and take advantage of the portfolio x-ray.
It's clear that you and your entire team at Allied Wealth know what you're doing, and you've got tactical strategies. We'll talk a little bit about that. But there's some folks out there who don't want to stomach this right now. They would maybe like to move over to something where it's get managed for them. I'm going to ask you about annuities when we get back from the break.
Four-letter word.
The four-letter A word.
Yep.
When we get back after this, please take advantage of your own complimentary portfolio x-ray. Ryan and the team have put this together because we realize what is happening right now in the markets. This is for you, Houston. Call us right now, 844-944-7555, and ask for your own complimentary portfolio x-ray. More with Ryan Wheelis and On the Money when we get back after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life, and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to On the Money with Ryan Wheelis. I am your host, Spike Spangle. Ryan, of course, is the founder of Allied Wealth right here in Houston. You have offices all around the Houston area.
You can hear our voice. We have an office close to you right now.
Right, yeah, exactly. And if you can hear our voice, we realize that you are worried about the markets. We hear you, Houston. We're getting the phone calls. We're getting emails. We understand. So what Ryan has been talking about is solutions. What can you actually do? We were just talking about in-service rollovers. Is it time to possibly get your money out of the 401k plan at work if you're over 59 and a half? Here's another one, though. There's a lot of folks who don't want anything to do with this anymore, and there's a lot of pitches out there say, hey, this is exactly what we were trying to tell you about years ago, annuities. Is this a time to completely move out of the markets right now?
You know, Spike, it depends. And some folks are realizing that the portfolio they were in, they never understood it could lose what it lost. And so as a result, their risk tolerance has changed dramatically. So, you know, an annuity is just a tool, all right? It can help get you where you want to go. And so there are annuities out there that have the ability to give you a bonus up front. So sometimes some of those will give you a 5 to 7% bonus to kind of help you recover market losses and move you into a situation to where you get market upside but zero downside. So where you are today plus a bonus of X, Y, or Z, 5 or 7%, is where you start. And you can never go below that value again, no matter what happens with the stock market, with the economy, or with interest rates. And some people find that very, very appealing. And so you can be somewhat of a market recovery plan, because if you're down, 20%, you can get 7% right away. So now you're down 13, and the annuity has pretty good upside from there. That's just one example, though. But so the thing is like there's all this bad press about annuities out there, right? Ken Fisher hates them, Dave Ramsey hates them. There's all this negative press out there, and folks, I mean, the bottom line is this. If an annuity helps you accomplish to where you get where you want to go, that's up to you. It's not up to somebody else. You got to make that decision for yourself.
Right. All right. So let me go back to that then, because you were saying how they manage in this way and that way. And isn't the tactical management what you're doing at Allied Wealth yourself?
It is. We manage our capital in-house at Allied Wealth. We take a mathematical, quantitative approach to investments to where we seek to capitalize on 70 to 80% of market returns and mitigate the downside risks around 30 or 40%. And we've been able to actually do within those numbers in some cases and do pretty well with it. And our clients have been very, very happy with the performance that we've given them in the last, the COVID crash, and thus far this year as well.
Okay, so I want to give you a little bit of time on this. Normally we're talking about the portfolio X-ray. We're going out to break. The music is playing. All right, you've got time here. The field is cleared. What exactly is the portfolio X-ray to you and to Matt and Peter and the team at Allied Wealth? Are you just going to take a look at the investments?
No, there's just so much more to it. And if somebody is at home right now watching the show and they're down 20, 25%, they're losing their confidence, they're losing confidence in their advisor, they shouldn't have, and they're shaking, they're starting to think about panicking, going to cash, they shouldn't have been in the portfolio they're in the first place. It's that simple. But what happens is we get complacent when the market goes up. And if the market's going up like gangbusters, all right, then it just goes up and up and up. We just think, hey, this is the way this happens. But folks, listen, complacency can kill you quicker than anything, all right? And that's exactly what we're experiencing right now. So what we want to do as part of the portfolio X-ray is the first thing is to build an asset recovery plan for you, right? And then that asset recovery plan is based on a couple of things. Let's get you back to where you were over time, but let's build systems and safeguards in place that where the next market crash that comes doesn't take you down 20%. Maybe your downside risk number you can afford is 5% or 10%. Let's try to build a strategy for you that will get no more than 5 or 10% of the downside. But in order to do that, we've got to kind of look at what you're holding, what you've got. How do we get you to that point? What's your risk tolerance? What's your risk capacity? What fees are you paying? Because if you're down right now 20, 25%, you're paying your advisor fees, guess what? You're not getting adequate value for the dollars you're investing in that relationship. And that's pretty scary because you're paying a professional for this stuff.
Right. One more thing, though, that's kind of scary to me about these markets in particular is that usually people, when they're looking to go to safety, if they're not so scared and just saying, I want to go to cash, they usually go over to bonds. How's the bond market doing right now?
That's why so much wealth has been wiped out. Really, it's two capacity spike. The bond market's down about 13.5% year to date. And usually the adage is what? Diversification. bonds down, stocks up, stocks down, bonds up, right? That's the way it's supposed to work. But this year we've had a collapse in the bond market because rates are going up big time, and that's which has led to a result in a crash in the stock market. And so people are experiencing it on kind of a double-edged sword, if you will. And the thing is that most portfolios that we evaluate through the portfolio X-ray, they're kind of stock and bond portfolios.
Right. Aren't they generally a 60-40?
60-40
Everybody's still
is
doing
what
that.
we see, right? Based on risk tolerance. But in the universe of investment options to them is stocks and bonds in most cases. So at Allied Wealth, we built portfolios that have a larger universe than that. For instance, the asset classes that are doing best this year are commodities by a mile. Well, our portfolios have the ability to allocate to things like gold and commodities automatically. And so you can't be pigeonholed into just two asset classes. You got to have more available to you, more firepower available to you.
And I know you well enough to know you're not saying for people to just load up onto commodities.
No.
Because who knows how quickly that market could change. We just don't know where it's going to go to next.
There is a time to be in any asset class at any given time. And there are ways to measure which asset classes to be in at the right times. Now, can anybody do that with 100% accuracy? Absolutely not. Can we do it without 100% accuracy? Absolutely not. But about 70 to 80% of the time when the market's going up, we can. And about 30 to 40% of the time when the market's going down, we can as well.
So if somebody is watching the program right now and they're sitting on the fence or they're sitting on their couch and they're just not sure yet, say, look, I'm working, I'm 62, there's probably not much I can do, or, this thing, it'll probably rebound, it'll come back. Talk to the folks out there in Houston who are on the fence.
Well, I've got a client who was with a very, 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 very big name investment house that was thinking that, and he experienced the upside of the bear market rally, which we just had, and I said, hey, get out. It's time to get out. He didn't listen, and he's right back down to where he was, all right? And he's feeling the pain right now. And so what he did is he went into a portfolio and he didn't understand the risk associated with that portfolio. He should have known that before going in, all right? And so part of the portfolio X-ray, folks, is we want to make sure you understand what you have, and is it possible to get back to even with what you've got? What does it look like to do that? And I can show you quantitatively if that's a possibility. Further, what is the risk you're paying, the fees you're paying in the account? What's the risk you're taking? What's your advisor doing to deliver returns for the dollars you're spending? That's all part of the portfolio X-ray. And to get it, all you got to do is call us. 844-944-7555. Again, 844-944-7555. And do you have enough confidence in your current financial advisor to seek a second opinion? Click that QR code and get one.
Thank you so much for watching On the Money with Ryan Wheelis. We will be back again with more retirement planning strategies for you, Houston, next week.